Okay, very good morning. Tuesday the 29th of August. Hope you all had a good long bank holiday weekend. We're obviously back into the fray, and a lot has happened over the weekend really from a fundamental point of view in terms of the news that's come out. Not a particularly busy day in yesterday's session, but then we've had a bit of a development seen very late on in regards to North Korea, which we're going to talk about in a bit more detail. But there's also other things that are ongoing. You've obviously had the real impact now that you're starting to see, and details are starting to come through from Hurricane Harvey on the Texan coast at the weekend. I'm sure you saw some of the imagery from that. Really devastating for the people who live in the Houston and in and around that area. And then the repercussion that this has had on the charts this morning. And as you can see, one of the messages I got yesterday while I was bathing in sunshine in the park, Will DeLucy sending me a picture of gold. And looking at gold here, obviously well above $1,300 now. Let me just put a line on the chart where that is. And you can see really how that was defining some of the price action in recent times. If we're looking at August, when we've had a bit of a pickup of really Korean tension, in addition to the looming debt ceiling issue in the US, has been some favourable themes to help elevate gold. But you can see 1300 at the beginning of the month acted as a bit of a barrier. We kind of had a bit of a false breakout mid-month on the 18th. We'd run up, I think it was 1306. And then we've tested it again on the 21st, tested it again on the 25th. But with this latest combination of news, we've really managed to catapult above this. In addition as well, of course, with the two big central bankers at the end of last week, Janet Yellen and Mario Draghi, really not saying a lot at all. And so here we are, we're up at overnight on the intraday pivot levels, close to testing R2, up at 1330 is where we've printed up at the highs, and we're trading up around $11 already before North American participants come in. Don't forget, they would have been in the marketplace yesterday, so really this new elevation here in the price, combination of the Korean development, we'll have a look at that in a second, and then also UK and European participants returning to the fold and reacting to this surge in prices we had yesterday. So gold, let's have a look longer dated, see where we are in the grander scheme of things. Remove some of these lines off my chart. So you can see that 1300, even if we go back, that was August test I was looking at, but you can see really it's rejected back in April and June of 2017. So by far these are year-to-date highs for the price of gold. Above here you can see that there's this really large wick on this candlestick. Of course, this was the night of the 8th of November. US election, Donald Trump. Surprising victory. Initial reaction, knee-jerk, was actually gold spiked the first few hours when he was winning the swing states, before we then know that Trump trade materialized the months thereafter, and gold really got hit on the back of that Trumpflation play. But at level of volatility on the night of the election, 1338. Above here then we're looking up on a bigger push, 1377.5 would be the 2016 highs. You can see that candlestick there. That large move on the upside was the big shock of the EU referendum that we had. And then going beyond here, obviously we're going to be going back to 1400 type levels. Looking at the 2014 high, that was just short of that, going back to 2013 levels. So it's still a bit of a way to go. We're trading, about $70 away from that at the moment, but don't forget we've risen here within the last 24 hours about $30 already. So you can't discount these types of elevated price levels if the right news supportive of that move was to materialize. But having a look then, you can see classic risk off play. Gold higher, the Japanese yen, although dollar yen's off its lowest levels, it's still down. Equity futures, you can see the S&P has gapped down here. The DAX has gapped lower as well. European equities on the back foot. You can see here this chart now just defining really the price over the month of August. From left to right, 1st of August here. We've broken through last week's low that was seen on Monday. And now we're targeting really the August low that was seen down in the DAX, 11,923. Trading about 50 points off that at the moment. So down 150 already this morning. Obviously a lot better volume today than yesterday with UK participants back into the market. Consequently then, T-notes up 12.5 ticks. Just flicking over to bunds, we're up 44 here. 165.40. So again, just reflective of an overall flight to quality move. Gold higher, Japanese yen stronger, T-notes higher, equities on the back foot. In terms of the currency market, the dollar index is down about 1/3%. Let's not forgetting you had Janet Yellen on Friday last week. It seems a long time ago now. We were awaiting that key speech, and really she said nothing. And so that was followed up on Friday night. Not sure if you saw that full article I posted in Draghi's speech, but he said really nothing either. And so as far as we can tell, we would kind of remain on track, so to speak, with the policy direction. And I would say, if anything, that's led to further euro strength, because the overall take basically from Janet Yellen is, if we don't hear of any additional details, then there's not a lot we can take from. And certainly a lot of people were awaiting Draghi to potentially say that the euro was becoming at important or significant levels, i.e. getting too strong, which would have lessened their hand to be hawkish. He didn't say anything, and so almost giving the green light then that policy remains on track in terms of their communication, this diverging from a weaker dollar, and so it's really fueled euro dollar to the upside. And you can see this morning 120 was a bit of a barrier in yesterday's kind of lower volume session. We got up there towards when Europe left, and US session we tested at 120. The break above that this morning with the better volume, with UK participants coming in above R1, we've already breached briefly R2, and that's where we sit at the moment this morning. Just looking at the euro longer dated, we are at significant levels here. You can see this pretty firm rise we've had really since May, June, July and August. Last 4 months we've gone from 110 to 120 here as the ECB start kind of greasing the wheels toward policy tightening coming up. And if you look at that 2012 low, and also around 2010, we broke through that, but we never really consolidated and moved for any period of time below there before recovering. 120.50, we're pretty much at that point at the moment. If you're looking, this is a monthly continuation chart. So significant levels here, technically long-term for the euro. And it'll be interesting to keep an ear out for any ECB commentary that comes from this week. Whether or not they're getting nervous about the overstretched value of the euro and the policy implications that might have, i.e. if they are fearful of the euro overshooting, i.e. getting too strong, which will be to the detriment of the economy in the eurozone, does that then start to alter the policy timeline that they have for tightening? So some really interesting things going on at the moment. The dollar weakness as well, you can see with both pairs in positive territory, but cable broadly flat. The other thing I was looking at, and we'll talk about, was Harvey and the impact that could have for US economic performance, and net then the Federal Reserve's judgment on the strength of the whole national economy, given the ramification that Harvey is going to have on the localized region around Houston. As a guideline, Houston is the 4th largest city by population in the United States of America. So this is a highly populous area. But okay, so the risk-off theme that we've got, what's happened? Well, this has occurred overnight. Let me show you this infographic. North Korea have shot a missile. The difference being, as you know, we've had roughly about 20 missile tests from North Korea year to date. But this was the first one, I believe, statistically since 2009, which has actually flown over geographically part of Japan, i.e. the northern island of Hokkaido. You can see here the missile, essentially, I believe that there were several that were fired, and I think it's only 3 times ever that this has happened, but a missile flew then over Japan islands itself before then breaking up and falling into the sea in the Pacific Ocean. Now obviously this has been condemned by Japanese PM Abe, who said a missile passing over Japan is an unprecedented and serious threat. To keep an eye out for commentary, the UN Security Council is holding an emergency meeting today. Donald Trump is believed to have spoken to the Japanese PM, but so far the White House has not issued a statement, and Trump has not tweeted anything on the matter as yet. Now I would say definitely I'd be very keeping a very keen eye on Twitter when it gets to about 11:30 our time, when Trump typically gets up in the morning, starts firing off on his Twitter account when he rolls out of bed, because I really want to know what type of tone does he take towards this latest provocation from North Korea in the peninsula. I think it could be quite important for sentiment today, particularly timing around 11:30 to 12 when Trump would classically tweet, for what has he got to say. How vehement is his response to this situation? Let's not forget as well, it's the 29th of August. There's still 2 more days to come of US and South Korean military drills within the peninsula. And so it could get very interesting later on. I feel like this situation could develop further and potentially escalate if Trump was to up the rhetoric slightly and become more aggressive in tone. I've just seen here that China's foreign ministry have also commented just a few minutes ago. They've said they oppose North Korea going against UN resolution and launching missiles. So obviously we'll be keeping an eye on what China has to add. But so far, China has remained diplomatic throughout, which has been highly important for this situation, remaining relatively controlled at this point in time at least. So that was the Korean situation, and that certainly has sparked some nervousness in the overnight Asia Pacific session. As you can imagine, South Korean markets coming under some pressure and heightening market concerns over tensions in that geographic region. Now, the next thing to look at is obviously the hurricane. Now, this is some of the headlines that I'm reading this morning, and I'm sure you've seen the same. And I've got some very interesting statistics that I want to run over with you that have been published by Deutsche Bank analysts this morning, which will hopefully put into a bit of context the ramification on the US economy that this hurricane situation and flooding is going to have. And so one thing is, oil prices really haven't reacted too much to this situation, but gasoline certainly has. So gasoline extended gains for a 6th session. Oil traded oil trading sub 47 this morning. It did decline actually yesterday. This is predominantly because of the refiners who are situated on the Texan coast, which have been impacted, and so hence it's more impeding the refining situation, and hence gasoline is the product that has moved rather than that of WTI crude. If you're looking at the divergence here, you can see with the white line being gasoline comparative to WTI, which is the blue line. So motor fuel prices have gained for a 6th day as the storm shuts refiners. Now, what I'm looking at here is a table of insured losses. So you can put into a bit of context the gravity of what's happened and the costs associated with it, because then this will help put into some kind of framework at least of what we can expect for its effect or impact on the US economy. So Katrina by far was the largest, and this particular hurricane is not on that kind of level. The experiences of hurricanes Gustav and Ike in September 2008 provide a reasonable benchmark with which to gauge the potential magnitude of weather-related disruptions in Texas, according to Deutsche Bank. So if you go to Hurricane Ike, floods, damaged oil rigs, so this was the US, the Caribbean, the Gulf of Mexico, this hits number 7 on the list, ended up insured losses of $22.6 billion US dollars. So that's kind of your reference point, at least at this point. Now, Deutsche add that Harvey could potentially drag on second half real US GDP growth by as much as minus 20 basis points, mainly through disruptions to exports. But they do say, though, that overall they don't think that this will have too much of an impact on US growth potential. And that's because although this situation might subtract 0.2% off GDP, the forecast for GDP going forward in the US is roughly about 2.7%. And so we're looking at 2.5 instead of 2.7, which materially is not, well, it's still a reflection of pretty decent economic growth. To be sure, some of the negative hit to growth will likely be offset by a boost to construction spending as rebuilding efforts get underway. Hence, this unfortunate event will not likely affect the overall trajectory of the economy and or monetary policy. So this is a really important thing, because obviously we're at this point of Fed monetary policy, of can they continue to follow this path of tightening the balance sheet as soon as next month, and then one more rate hike, which they've telegraphed all the way since the beginning of the year that they would deliver 3. They've done 2. Can they deliver the 3rd, which most believe would probably be in December if that were to be the case. Now, just quickly showing you, at the end of last week, this was prior to Janet Yellen speaking, federal funds futures, so this is the short end of the curve, which is more interest rate sensitive, was pricing in approximately a 44.5% chance of an interest rate hike in the US in the month of December. This is what that percentage looks like this morning. That is now down to 31%. So it was 44% before Yellen spoke. It's now at basically 31% probability that rates will rise in December. So as far as the market is priced or positioned at this present point in time, the market does not believe that the Fed are going to be able to deliver on that promise. Now, part of this is the Fed communication, some of the sentiment and takeaway from what Yellen said, but also this Harvey situation might make them nervous, and what already is a problem with inflation moving further away from target, which is all against the Fed having the right conditions in able to be able to follow through on what they have been communicating. So T-notes, as you can see, continue to remain on the upside. You know, we haven't even got on to other things like the US debt ceiling, the risk of that also rearing its head. Just while I'm on that subject, this is another interesting statistic I saw at the weekend. US debt ceiling concerns increased 2 weeks ahead of the deadline. This is going off historical based studies and typically leads to risk-off dynamics and tighter front-end spreads. So it was 2013 the last time we had a physical government shutdown. I believe that lasted for some 16 days at the time. But this is definitely, although most would believe that when push comes to shove, an 11th hour deal will get pushed through, that's certainly what the likes of Paul Ryan has been suggesting, irrespective of what Trump has been trying to leverage. This definitely just adds another dynamic to the mix, which you would think would make it incredibly hard for the Federal Reserve to remain in hawkish mode, not with all the other things that are going on geographically or geopolitically as well. Going back to the storm though, this was another chart which I was sharing with you at the end of last week, and now that we kind of have known the path and where Harvey had hit and the path that it took thereafter, you can see just a real devastation where it hit straight through Corpus Christi, through Victoria, and then it's come back out and then back inland as it's kind of started to dissipate in its velocity. But what the EIA also publish here, which can be quite useful, is they have this flood vulnerability assessment map, which updates in real time, and this can be fairly insightful for seeing then how much impact that the storm has had over the various sites. So what we're looking at here is, if I click on that little graphic there with the kind of oil drop, that's a natural gas power plant. Whereas if you look at the triangle here, the kind of beige triangle with the barrel, that basically is a petroleum product terminal. And so you can see exactly where the flooding has occurred and where then these particular sites have been most impacted. Can be very useful. Again, some other statistics which I think will make more sense to you when you hear information on Harvey. So as I said, Houston is the 4th largest city in the US. It has a population of roughly 2.3 million people. It accounts for somewhere north of 3% of entire US real GDP. So highly influential then, you could argue. But for those reasons that Deutsche said, maybe the impact might be negated by the fact that this negative hit to growth will likely be offset by a boost to construction spending. In terms of specifically for oil though, according to the US Department of Energy, Gustav and Ike, so those two I refer to back to 2008, which this particular Hurricane Harvey is the most similar in size to, those previous two, Gustav and Ike, took out 22% of refining capacity at the time, which was equivalent of around 3.9 million barrels per day. As a timeline, when those two previous weather patterns hit, nearly all of that capacity was back online within 2 weeks. So that's the type of time frame that you'd be looking at for it to return. What does this mean for the jobs situation? Because a lot of you who've been in the market long enough will remember that these types of weather situations that can happen in the Gulf or even in Northeast, where we've had severe weather conditions, can affect the jobs situation as well. So again, these are things which the Fed will need to take into account with its tightening of policy. The jobs market, in terms of jobs creation, hasn't been too much of an issue. The wage inflation part has. If the jobs situation starts to come into question, again, it really makes the Fed's hawkish hand difficult to maintain. As a reference point then, in September 2008, there was a large increase in weather workers, or those who had a job but were not able to work or forced to work reduced hours because of bad weather. Hence, it is possible that non-farm payrolls could be soft in September relative to the recent trend. So that's not the payrolls we're looking at that's going to come out Friday, but the one thereafter. You might then see this weather-related fluctuation when we see that. And actually, just while I'm on that, let me show you this in effect, because I remember when we had that adverse weather conditions on the northeast coast at the beginning of the year, this really did have a quite clear ramification on the job growth situation. You guys remember the 50k print that we had, non-farm payrolls? And the market looked at that 50k and was completely nonplussed in terms of market reaction. Why? Because the market knew that that specific report would be impeded by the weather conditions that affected the northeast coast of America, and obviously the highly populous area of the New York State. And that's why that figure is so artificially low, and therefore has actually been removed kind of out of calculation as a one-off hit, taking the average as the overall assessment. Okay, just before I move on, just a quick look at the charts again. I can see gold coming up to have another little look up at that 1330. You can see this top right, so I'm definitely keeping a close eye on that price movement. And as I say, all these things I've just talked about make it very difficult, I feel, for the Fed to remain quite hawkish as they have been. And this coming in the dynamic of the ECB seemingly not panicking over the strength of the euro, i.e. keeping them on track. start signalling about the details towards tapering down on QE going into next year. This very favourable then for the dynamic for a move higher in euro dollar, and that's certainly what you've seen materialise over the last 24 hours, and the pair remains on the front foot. You can see this is real euro strength as well, because the euro dollar pair is up 63. If you look at cable, we're only up 20. So definitely it's being euro led at this present point. The stronger the euro gets, this just starts to add even more further headwind to the European related export names in the equity space, particularly that in the German DAX, which has a high proportion of export names. Just think Daimler, BMW, Volkswagen, those types of names. So as well, keep an eye on that DAX on the August low in the futures. We're not too far from there at the moment. One would think any breach of that level could see another extension of a push lower. There you go. Just as I'm speaking, the DAX, another little pop on the downside there. So very interesting levels coming up here. And as you know, that particular product can move very quickly. Okay, I'll keep an eye on that while I finish the wrap. The other thing then, just quickly to kind of go through the rest of the news of the weekend. As I said, sterling up more, I'd say, dollar weakness, but there is also a favourable headwind for the pound that's come out of the weekend's news, and that is because Labour, the kind of rising influence of the opposition party, given their outperformance in the general election that we had just a few months ago, Labour have made a dramatic Brexit shift and back single market membership. This obviously is going to make life increasingly more difficult for Theresa May and her hard Brexit Tory stance when you've got the kind of momentum, if you like, off the back of the election behind the Labour camp, and they're now looking at backing single market membership. This would obviously lead to the premise of a more softer Brexit outcome, which hypothetically should translate into being more sterling positive. So that being then that Theresa May would find it incredibly difficult to maintain her hard line stance when it comes to debating this and getting backing off of Parliament. And so again, just another twist in the tail here. As a guideline, yesterday was the first round of the latest Brexit talks have kicked off. EU's chief negotiator Barnier said yesterday he is concerned about the progress of the talks and urged the UK to start negotiating seriously. It's looking more and more likely then. One EU diplomat said many countries were ready to wait until the end of the year for the divorce deal rather than early autumn as the British had hoped for. Remember, the longer it takes for this divorce bill to get settled, the shorter the timeline is to then start negotiating the more important things at play, that being the transitional deal and the trade talks that follow thereafter. I do feel like this divorce bill is inevitable at a certain point in the future. And actually, I did tweet, I'm not sure if you guys saw a tweet that I did, a graphic I shared in Trading Live last week, if I can find it just quickly. Here it is. This is the current range of estimates for Britain's bill to exit the EU. We have a most optimistic case in terms of the UK of paying Europe 24.5 billion, or you have a most pessimistic or worst case scenario as far as the UK is concerned, we would have to pay 72.8 billion. So what you found here is that this kind of 1 billion to 100 billion range already within the last 2 months has now come in towards 25 to 73 billion. I would expect that to come in again. It's looking more and more likely that this overall bill gets settled around the 40 to 50 billion region, which again is going to be very difficult for Theresa May to sell that to the British public. In order to achieve Brexit, it's going to cost you almost £50 billion. And although she doesn't have a choice, and that's not her fault, this probably wasn't factored in to most people's thinking. I'm sure when they were voting during the EU referendum, and this is only probably going to add further disgruntlement to the ruling Conservative government. Okay, so wrapping up then, let's have a quick look at the calendar for today, and then we'll look at the calendar for the week, because obviously this is a very important week, as we're going to see shortly. And so for today's session, it is fairly quiet this morning. There's not too much actually going on, which just means then you need to be watching market sentiment very closely, particularly in the context of the type of news that we've had. The hurricane, the North Korean situation with the missile flying this time, importantly, over Japan, which is a new development and hasn't happened for approximately 8 years as far as I'm aware, and only on 3 times in history has it ever flown over actual geographically over Japanese territory in terms of land mass. This whole kind of rethinking then of what this might mean for federal policy, and it's continuing to lead this flight to quality bid. So Euro trade looking quite compelling from a fundamental point of view with this policy divergence materializing. Gold needs to be watched as well in this retest of that high print that was seen overnight in the Asia Pac session on 1330, and the DAX on that level I mentioned. But going into the afternoon, again, it remains pretty quiet. Case-Shiller really is a non-event. I wouldn't be too concerned about that figure. US consumer confidence, though, could be interesting, particularly with the kind of growing, you would sense, almost discontent over how Trump has been dealing with issues such as Charlottesville and Virginia, which happened 2 weeks ago now, how that is impacting people's overall consumer sentiment, if at all. So that's definitely going to be something of interest. And then you've got the API crude oil inventories. Remember, these will be released normal pattern because it was not a US holiday on Monday. So we'll get the APIs tonight, the DOEs as per usual on Wednesday afternoon. Fed speaker, following on from Yellen on Friday, I would definitely be keeping an ear out as well for Fed's Evans, who is a voter, and speaking at a bank directors conference that'll be at 4 p.m. London time. Okay, finally, quick look at the week in its entirety. So Wednesday, you've got UK lending data, mortgage approvals. I did see that UK housing data this morning, nationwide house price index month on month minus 0.1%. Expectations were plus 0.1. So these large ticket kind of items, like people willing to step into taking a new mortgage, is, you know, appetite is dwindling under the uncertainty that we've got in the UK economy over the Brexit situation. Elsewhere, ADP, this being then your kind of barometer for the key non-farm payrolls report, which we'll get on Friday. Moving on to Thursday, manufacturing PMI data for China when we come in. That'll be interesting. Then you've got the inflation rate for the euro area and unemployment rate. The former of that, inflation, obviously a key metric that the ECB are monitoring. Key data then coming out of the US, Chicago PMI, and then coming into Friday, we get further the private Kaizen manufacturing PMI reading out of from the overnight session, manufacturing, but these are final readings for Europe, UK, and then non-farm payrolls. We finished the week off. So good week, actually. It's going to be pretty jam-packed in terms of the economic calendar. And just going off the market sentiment this morning, certainly quite a lot going on. So I'm going to leave it at that. I can see things are still moving at the moment. Continuation of a flight to quality move on the back of the multiple reasons that we've talked about this morning. So, okay, guys. As Michael's just pointing out, fourth test that we've had on gold. So it's had a little look. Be interested to see whether this 1330 now acts as a bit of a platform for the next push on the upside. Up $15 now. Okay, guys, have a good day. If you need any help, any questions at all, then I'll be available in the chat room as per normal. Thank you very much.